This is not clickbait. This is not another wild theory you'll forget about tomorrow. What I'm about to reveal is a confirmed strategic move that went into effect at midnight on January 1st, 2026. And it's about to shake the Western financial system to its core. While you are celebrating New Year's Eve, enjoying fireworks and making promises you probably won't keep, one of the world's superpowers just pulled off the most significant commodities power play since 2010. And if you think this will just blow over like every other trade headline, you're about to discover why this time is fundamentally different. Before we dive deeper, do me a favor right now. Hit that subscribe button and turn on notifications, because what you're about to learn won't make it to mainstream news until it's already too late. I'm talking about information that could impact your financial future, whether you're invested in precious metals or not. The channel is Final Wealth Warning, and we're here to cut through the noise and give you the real story. Drop a comment below and tell me if you're already tracking the situation or if this is completely new to you. Your engagement helps this critical information reach more people, so take 2 seconds and let me know you're watching. Now, let me tell you exactly what happened on January 1st, 2026. This is not speculation from random internet forums or guesswork from people who have never actually traded physical metals. This is documented fact, backed by official government announcements and verified by people who move real metal for a living. The Chinese government just restructured their entire silver export system overnight, and the implications are staggering. On December 30th, 2025, China released an official list. Just 44 companies. That's the total number of firms in the entire nation that are now authorized to export silver. This wasn't a gradual tightening of regulations that companies could prepare for. This was an instant transformation of the entire framework, activated while most of the Western world was recovering from New Year's celebrations. But here's what should really grab your attention. This didn't come out of nowhere. Let me take you back exactly 2 months. On October 30th, 2025, President Trump met with Chinese President Xi Jinping in South Korea. The headlines from that meeting were all positive. China agreed to pause their rare earth export restrictions announced on October 9th. The United States agreed to reduce certain tariffs. Diplomats shook hands, cameras flashed, markets celebrated, and everyone thought a major crisis had been avoided. But on that exact same day, while the world was distracted by the rare earth compromise, China quietly introduced new export restrictions on 3 different metals: silver, antimony, and tungsten. Notice what happened here. China gave ground on rare earths, a market where they're already facing new competition from mines in Australia and the United States. In exchange, they tightened their grip on metals where their dominance is even more absolute. This wasn't a compromise. This was a calculated strategic shift executed in plain sight while everyone was looking the other way. They traded away something becoming less valuable for complete control over something far more critical. Now, before we continue, let me be absolutely clear about something. Everything I'm sharing with you is based on publicly available data, official government announcements, and verified market reports from established sources. This is not financial advice. I'm not telling you to buy anything, sell anything, or make any specific moves with your money. I'm laying out the facts as they exist right now so you can make your own informed decisions. What you choose to do with this information is entirely your responsibility. Let me show you why this policy change isn't just about trade negotiations or political posturing. This is about control over a physical supply chain that cannot be easily replaced, cannot be substituted, and cannot be ramped up fast enough to meet the demand that is already locked in for the next several years. China doesn't just mine silver. They refine it, they process it, they control an estimated 60 to 70% of the world's refined silver supply. That means even if you mine silver in Mexico, Peru, or Australia, there's a strong chance that metal is getting shipped to China for refining before it ever reaches a Western vault or manufacturing facility. And now those Chinese refineries are operating under a government directive that puts domestic needs first, export approval second, and Western markets dead last. So what are those domestic needs? Solar panels. China is installing solar capacity at a rate that consumes hundreds of millions of ounces of silver annually. Electric vehicles. Every EV battery system requires silver contacts and wiring that cannot be replaced with cheaper alternatives. Electronics and semiconductors. The entire global tech manufacturing infrastructure depends on silver. China is no longer willing to export the metal their own industries desperately need to function. This isn't about making profits on commodity trades. This is about securing the inputs for the industries that will define economic and military power for the next half century. But here's where it becomes truly dangerous for the Western financial system. While China was systematically locking down physical supply, the COMEX futures exchange in New York was operating under the assumption that they could always source metal from somewhere. They built a massive market where paper contracts outnumber physical bars by a ratio that would shock most people. Let me give you the actual numbers, and I want you to pay very close attention because this is where the mathematics stop making sense. Right now, COMEX has approximately 82 million ounces of silver in the registered category. That's the metal that's actually available for delivery against futures contracts. Not eligible metal sitting in vaults owned by someone else. Not silver that might arrive next week. 82 million ounces that can be delivered today. Now let me tell you what's on the other side of that equation. The current open interest in COMEX silver futures is roughly 165,250 contracts. Each contract represents 5,000 ounces. Do the calculation with me. 165,850 times 5,000 equals 829 million ounces of silver that could theoretically be demanded for delivery, 829 million ounces of paper claims, 82 million ounces of physical metal available. That's a ratio of more than 10 to 1. For every actual bar of silver sitting in a COMEX vault, there are more than 10 paper promises circulating in the market. In a normally functioning market, this isn't necessarily a problem because most traders don't stand for delivery. They roll their contracts forward, they cash settle, they trade the paper without ever touching the physical metal. That's how commodity futures are designed to work. But we're not in a normal market anymore. We're in a market where the largest supplier of physical metal just walked away from the export game. And suddenly, everyone who assumed they could source silver when they needed it is realizing the metal simply is not there. If you're enjoying this deep dive and want more analysis like this, make sure you've hit that subscribe button. Comment below and tell me what you think. Is COMEX actually under real stress, or is this situation overblown? I read every single comment, and your perspective matters. Share this video with anyone you know who needs to understand what is happening in the commodities markets right now. The mainstream media won't cover this until it's too late. If you think I'm exaggerating the severity of this situation, let me tell you what happened in Shanghai in the final week of December. The Shanghai Futures Exchange, which is the primary platform for physical metal trading in Asia, experienced the largest weekly outflow of silver in its entire history. 257 tons drained from the vaults in just 1 week. Not over a month, not over a quarter. In 7 days, approximately 8.2 million ounces vanished from registered inventory, while demand continues accelerating and export permits are being systematically denied. This isn't a gradual drawdown. This is a bank run on physical metal happening in real time. So now let me connect these dots in a way that almost nobody in mainstream financial media is willing to say openly. If you're holding a COMEX silver futures contract, you're holding a piece of paper that promises you 5,000 ounces of silver at a specified price on a specified date. That contract was sold to you by a bank or trading firm that assumed they could always go into the market. Purchase the physical metal at a small premium above the futures price and deliver it to you if you demanded it. That fundamental assumption just broke. The physical metal isn't flowing out of China anymore. The Shanghai vaults are draining rapidly. COMEX registered inventory is down approximately 70% from where it stood in 2020. And the institutions that sold those contracts are beginning to realize they may not be able to perform on the promises they made. What happens when a promise cannot be kept? In the financial system, you get a default. But defaults in commodity markets don't look like defaults in bond markets. Nobody files for bankruptcy. There's no Chapter 11 proceeding. What happens instead is that the exchange changes the rules. They force cash settlement at a price they determine, and they inform the people counting on physical delivery that they're receiving a check instead. If that sounds insane, if you think they can't just rewrite the terms of a contract after you've already purchased it, then you haven't been paying attention to how these markets actually operate when the system comes under stress. On December 30th, the CME Group, which owns and operates COMEX, issued Advisory 25-393. Buried inside that advisory was a margin requirement increase for silver futures. They raised the margin to $25,000 per contract. That's a 30% increase. The official explanation is that this is routine risk management. But let me tell you what it actually accomplishes. When you raise margin requirements by 30%, you force traders using leverage to either post significantly more cash immediately or liquidate their positions. And when you force liquidations in a rising market, you create selling pressure that drives the price down. Convenient timing, isn't it? The price of silver had just reached $80 per ounce in late December. Physical premiums in Shanghai were running $8 to $10 above the COMEX futures price. The market was screaming that there's not enough metal to satisfy demand, and the exchange responded by raising the cost to maintain a long position, triggering a wave of forced selling that knocked the price down by more than $12 in just a few days. Ask yourself this question. If COMEX truly believed the silver market was functioning normally, that supply and demand were balanced, and that there was no stress in the system, why would they need to raise margin requirements by 30% in the final week of December? The answer is obvious. They raised margins because they know what's coming. They know the physical supply from China is gone. They know inventories are at decade lows. And they know that if too many contract holders decide to stand for delivery in January or February, the exchange will not be able to perform. So they're taking preemptive action to shake out speculators, reduce open interest, and lower the number of contracts that might demand physical settlement. But here's the critical problem. Industrial users cannot be shaken out. Solar panel manufacturers need silver to coat photovoltaic cells. Electronics companies need silver for circuit boards and connectors. These aren't speculators gambling on price movements. These are real businesses with production schedules, supply contracts, and customers waiting for finished products. They cannot accept cash settlement. They need the actual physical metal. And when they go to the market to secure that metal, they're discovering that the gap between the futures price and the cost of immediate physical delivery ain't $2 or $3 anymore. It's $8, $10, and in some regional markets, it's running even higher. Let me tell you what some prominent experts are predicting and why you should pay attention even if you've never traded a commodity contract in your life. Robert Kiyosaki, author of Rich Dad, Poor Dad, has publicly stated that he expects silver to hit $200 per ounce by the end of 2026. Analysts at major financial institutions are publishing price targets of $100 to $110. Mike Maloney, who has tracked precious metals for decades, has said the current setup resembles the early stages of a parabolic move that could push silver into triple-digit territory and keep it there for years. These aren't fringe voices. These are individuals who have been correct before, who understand market structure, and who are analyzing the same inventory data and policy changes we're discussing right now. But here's what none of them can tell you with absolute certainty. They cannot tell you the exact moment when the stress at COMEX transforms into an actual delivery failure. They cannot tell you whether the exchange will change the rules before that happens or after. And they cannot tell you how the Chinese government will respond if Western markets start demanding silver and Beijing simply says the metal is not for sale. What they can tell you is that the conditions for a historic repricing event are completely in place. A structural supply deficit that has persisted for 5 consecutive years. A cumulative shortfall of 800 million ounces since 2021. A dominant supplier that just locked down exports. And a futures market with 10 times more paper claims than physical metal. That's not a recipe for business as usual. That's a powder keg with an extremely short fuse. If you're still skeptical, if you think this is just another commodity cycle that will self-correct in a few months, let me walk you through what happened the last time a critical industrial metal faced a supply shock of this magnitude. In 2005, copper prices were stable, supply was adequate, and nobody was discussing shortages. Then China started stockpiling copper to fuel its industrial expansion. Within 12 months, the price had tripled. Not doubled, tripled. And it remained elevated for years, because once the physical supply tightness became apparent, the entire market had to reprice the forward curve to reflect the new reality that you couldn't simply call a supplier and get metal delivered the following week. Silver is following the same pattern, except the supply shock is more severe, the industrial demand is more inelastic, and the paper market overhang is substantially larger. Solar manufacturers cannot wait 6 months for prices to stabilize. They have installation deadlines and government contracts with penalties for delays. This is Final Wealth Warning, and I'm bringing you this information because it matters. If you found this valuable, subscribe now and turn on notifications so you don't miss what happens next. Share this video because people need to understand what's developing in real time. Comment below and let me know your thoughts on whether COMEX is truly under stress or if this will resolve itself. Your engagement helps spread this critical information to more people who need to see it. The financial landscape is changing rapidly, and being informed is your best defense. Stay alert, stay informed, and I'll see you in the next one.